Welcome. I'm Scott Hodge, President of the Tax Foundation. Thank you for joining us today for another Tax Foundation Talking Tax webinar. And today we're going to focus on international tax policy, specifically the global tax debate over how to tax the digital economy. But first, a few housekeeping items. Today's program is being recorded, and you're welcome to view it later on. We'll be sending that out. And of course, it's being broadcast also live on YouTube. You are able to submit questions. We will post that here in a second on how to do that. And be sure to include the name of the panelist, etc. We got a lot of questions as people signed up for the program. So we hope to get as many as possible. So bear with us as we try to get through all those great questions. This is such a hot topic. Well, today's program was prompted by a letter from U.S. Treasury Secretary Steven Mnuchin to his counterparts in France, Italy, Spain, and the United Kingdom. Well, this was not supposed to be a public letter. On the contrary, it was leaked and reported on by the Financial Times. Now, this may not be one of those letters that changes the course of history, but it did cause quite a stir in the tax community. And in his letter, Secretary Mnuchin points to an apparent impasse in the OECD's ongoing discussion as to how and when digital companies should be taxed. He suggests a pause in these discussions while world leaders deal with the economic fallout from COVID-19. He also reiterated the US's objection to the proliferation of digital services taxes, which he says are unfairly aimed at US companies. And he promised retaliatory measures from the US if those taxes are imposed by a growing number of countries. Now, Mnuchin's four counterparts responded a few days later with their own letter, saying that, quote, postponing our work and not addressing these challenges would constitute a collective failure. They went on to say that a political agreement on a multilateral, stable solution would also alleviate the need for governments to take action. Then they threw down the gauntlet, saying, quote, digital giants, no matter where they are headquartered, will emerge from the current crisis more powerful and more profitable. These companies benefit from free access to the European market. It is fair and legitimate to expect that they pay their fair share of tax within countries where they create value and profit, end quote. Well, we have quite a divergence of views across the Atlantic here. So the question is, will this war of words lead to a tax war wrapped up in a trade war, or maybe a trade war wrapped up in a tax war? Well, our mission today is to bring you up to date on the intertwined and interdependent issues that have brought this war of words to a head. And first, we'll discuss the status of the OECD digital tax project that Secretary Mnuchin alludes to as reinventing an international tax system that he says has stood the test of time for 100 years. And then we'll move on to sort out the bilateral disputes over digital services taxes and what this means about the threat of retaliatory tariffs. Well, we have an all-star panel to discuss these issues. First up will be my colleague, Daniel Bunn, Vice President of Global Projects at the Tax Foundation. Daniel will give us the background on the digital taxes debate and talk about why multilateralism is needed to promote international stability for economic growth. And then we'll have Bob Stack, Managing Director at Deloitte's International Tax Group and a veteran of this debate. Bob will talk about the current status of the OECD project and what to expect given the recent US letter. And then we'll have Kathy Schultz, Vice President at the National Foreign Trade Council, another veteran of the debate. Kathy will talk about the challenges of digital services taxes and the potential for retaliatory tariffs. That's quite a lineup and quite a bunch of issues to tackle. Thank you all for joining us, and thank you, panel. Daniel, the floor is yours to kick us off.
Thanks, Scott. So I'm going to talk about two important issues to set the stage for our discussion about what we might expect from policy in the near future. The first issue is the rise of digital technologies that undermine the need for local offices in countries around the world. Businesses can use digital tech to reach across borders and into markets without needing local employees, offices, or operations. And this is where taxable physical presence and nexus shows up in policy concerns. In 2017, there was nearly $30 trillion worth of e-commerce, with the majority of that being businesses selling to other businesses. The geography of internet users doesn't necessarily track with the production locations of valuable computer and software platforms. And most of the value production occurs in North America, and the internet user base is skewed towards Southeast Asia. So policy responses to this include digital services taxes, virtual permanent establishment rules, and the OECD's Pillar 1 approach. The second big issue is the rise of intangible assets, software, patents, and so on, as significant value drivers in the global economy. Intangible assets, by their nature, can be moved from one jurisdiction to another without the trouble that, say, uprooting and relocating a factory would create. In 2018, intangible assets made up for 80% of the asset value of the S&P 500 companies. And these intangible assets are often shifted to lower tax jurisdictions, and this motivates a discussion of minimum tax policies like the US GILTI policy and the OECD's Pillar 2 GLOBE proposal. So with those two baseline issues, the physical presence issue and the rise of intangible assets, I'll give a few examples of policy responses and talk about the economic implications. The more and more that businesses can reach their clients virtually, the less likely there will be a local permanent establishment for a foreign country to tax. In short, this has led to two major policy directions, the first being digital services taxes, and then also new corporate income tax rules. Now, behind these policy approaches is a key division in the digital tax debate that came up in those letters that Scott mentioned. Do you change the rules for just a few digital companies, or should you try to make broad changes that affect other companies that aren't necessarily digital, but have digitalized business models? They're still reaching their clients through digital means. The digital services tax takes the narrower approach. It is a tax on gross revenues of certain defined digital services. Here's a map. Let's see here. Here's a map. Let me share my screen of digital services taxes in Europe. Now, the French digital services tax, which came into effect last year, has a 3% rate and applies to revenues connected to the provision of a digital interface or advertising services based on users' data. Now, it applies to businesses with more than 750 million euros in global revenues and 25 million euros in revenues in France. This tax model, as you can see in the map, is being replicated in dozens of countries across the world, and particularly in Europe. Now, the problem with this approach is twofold. First, gross revenue taxation cannot be a proxy for corporate income taxation. Revenue taxes, by their nature, are regressive. So if you have a 6% profit margin in France, the digital services tax is effectively a 50% profits tax. If you have a 3% profit margin on your digital activities in France, the 3% digital services tax taxes all of that away, essentially a 100% profits tax. And if you're running in losses in France, well, you still have to pay the digital services tax. Now, just for context, the French corporate income tax rate is about 32%. Now, some countries claim that digital companies are undertaxed and see the digital services tax as a solution. Well, the evidence those claims are based on doesn't actually support the conclusion that digital companies are undertaxed. Rather, it shows that countries have tax preferences for the digital firms in form of patent boxes and research and development subsidies. Not all digital companies use these preferences, but they're available, and that can drive differences in effective tax rates. Second, the problem these countries are really addressing, or that they think there is where the companies are taxed. And they've chosen to change the rules about where companies are taxed unilaterally using a discriminatory and punitive tax. So if the digital services tax is, in theory, paid in lieu of a corporate income tax, it's a horrible proxy because it's a gross revenue tax. Additionally, these are narrow targeted policies. Tax policy should not be designed on an industry by industry basis or with special rules for big versus small players. Yet these policies do exactly that. They identify specific digital activities or business models, separating large from small businesses, and they tax them in a regressive manner in what looks like a pretty protectionist intent. And that protectionism comes out rather clearly when you have the tax policy leaders in the UK, France, Italy, and Spain suggesting to the US Treasury Secretary that digital taxation is connected to the free access that digital companies have to the European market. The digital services tax essentially works like a tariff. So another approach to solving the no local physical presence challenge has been to change definitions of permanent establishment. Instead of only taxing a business if it has employees or operations in your country, you could write rules to tax a business based on virtual presence. Basically, if a company has lots of contracts in your country or lots of sales in your country through digital means, then these new rules would treat that business as having a virtual permanent establishment. Countries such as Israel, India, Nigeria, Slovakia have looked at this sort of approach. And that is one area the OECD is working on in Pillar 1 with the goal of redefining taxable nexus based on a new approach. The OECD Pillar 1 approach would change where companies pay taxes, but only large, highly profitable companies and only companies in certain sectors, namely automated digital services and consumer-facing businesses. And in recent weeks, we've learned that some countries want to start just with the automated digital services part of that approach. Essentially, we're back to the problems with the digital services tax, a narrow policy designed for just certain large businesses and only certain types of activities. And that narrowness comes into conflict with countries that want a broader approach to changing international rules. The United States has advocated for a broader approach, notwithstanding the Pillar 1 safe harbor proposal. And the US has been met with calls focused more narrowly on just digital companies, which many happen to reside in the US. So that covers the first big issue, the rise of digital technologies that undermine the need for local offices in countries around the world. The second issue, the rise of intangible assets, software, patents, and so on, as significant value drivers in the economy, has led dozens of countries to adopt patent boxes or similar incentives to attract those assets. In many cases, patent boxes give a 50% or greater discount off the corporate tax rate. Some recent policy changes require the research and development or management activities associated with those patents to occur in the same jurisdiction for the business to benefit from that corporate rate discount. But the lower level of taxation still occurs and can distort where patents are owned and where research and development activities occur. So what are countries looking at to tax the shiftiness of intangible income? Well, they're looking at the US model. The US now has a minimum tax on foreign intangible income. We call it GILTI, Global Intangible Low Tax Income. And it was adopted in 2017 as part of our big tax reform. Other countries are interested in having a similar policy agreed to at the global level. And this is where Pillar 2 of the OECD approach comes in. Now, it's worth mentioning here that the OECD has estimated that the combined effect of Pillar 1 and Pillar 2 would be a net tax increase of $100 billion worldwide. Now, there are challenges with that estimate, not least of which is that it relies on data that is prior to a lot of policy changes, including US tax reform. So that number has a wide error band and could be much less of a meaningful revenue raiser than a meaningful compliance and coordination headache. So to wrap up, what's at stake with these competing proposals? We have digital services taxes, Pillar 1, Pillar 2, other digital taxes. One thing that is at risk is the potential for a global tax and trade war. The digital services taxes are likely to spark that war because of their narrow discriminatory approach. And the multilateral discussion at the OECD is meant to achieve a common approach rather than erecting new tax and trade barriers. However, even in the multilateral discussion at the OECD, another risk is a shift in international tax policy from broad rules and principles to narrow rules that lead to new distortions in multinational activities. Now, over the last several years, there have been lots of new developments on these policies. Here's a relatively condensed timeline. Let me get back to my slide here, and we'll go to the timeline. There have been both unilateral and multilateral elements over the years, but a lot of policy activity has been happening in this space. And things on the policy front are clearly accelerating these days, as Scott's reference to those letters indicate. Policymakers should examine these policies against sound principles for tax policy. If international tax policy becomes unilateral and reactionary, it will very likely become unstable, less transparent, more distortionary, and even more complex than what we have right now. And this would become a drag on global growth right at a time when the economy is incredibly weak. So with that, I'll pass things over to Bob to talk about where things stand with the OECD negotiations.
Thank you, Daniel, for that terrific introduction. And I think I'll just open, maybe following up on your last point, which is there's a tremendous appetite for these multilateral solutions as opposed to the unilateral ones. And a lot of business groups have come out this week and said, even though we're having a pause, we still think we need to get around the table and search for this multilateral solution that everybody's been aiming for. But in terms of the progress at the OECD, no question, we're at a pause. But as I'll discuss a little more later, the pause is maybe different when we think of technical work and the political policy elements. And I want to go into that a little bit. But the political level pause, as governments deal with the fallout from COVID-19, it's obviously difficult to get the attention at the senior levels of these governments to make many of the tricky political and policy decisions needed to advance the ball in the talks. That's just a matter of kind of common sense. When I worked at Treasury, you had to get on your boss's calendar in order to get decisions made on various things. And that just becomes, as a practical matter, much harder. And that's the point Treasury Secretary Mnuchin made in his June 12th letter. The US had previously made this point at the OECD, and as you saw in the finance minister response letter, got a fair amount of pushback. But it would really surprise me if the United States is the only government finding itself preoccupied by the COVID fallout, that would have had this impact on the succession of the movement forward of the talks. Now, the June 12th letter was the second letter from Treasury Secretary that caused some upheaval in the talks. The first was his December 3rd, 2019 letter, suggesting that the US could only support Pillar 1 if done as a safe harbor. So we know there's a pause, and I said, I opened up by saying, and the OECD has said, we're going to continue to have the meetings, US representatives will still go, the project is continuing, I think all that's clear. There are a lot of people working on these technical details. But in terms of making the tough decisions that you need to really advance the ball, just consider that the inclusive framework, which is what the OECD has grown out to be now, and with the first OECD when we were doing BEPS with the G20, now we've added a bunch of other countries, so we have almost 138 countries forming the inclusive framework. Their 2020 deadline, the current was originally built around an October inclusive framework meeting, running up to the G20 finance minister and central bank governors meeting in Washington, October 15 and 16, which of course is before the US elections. Now, bear in mind, the OECD was originally hoping to get to a political solution first at the end of 2019, then by July of 2020. So this has been challenging on many levels, even before COVID, and we just have to keep that in the back of our mind. Now, Treasury Secretary's letter expressed the desire that later, quote, later in 2020, an agreement on Pillar 1 can be reached. And Pascal Saint-Amand has said publicly, and this was somewhat reiterated by the Secretary General Gurria in a Politico interview yesterday, that, maybe we could get something after the US elections, and maybe we could continue to do some technical work to get us almost all the way to the solution. Pascal interpreted the Secretary's remark later in 2020 to mean after the US election, which seems to me to be a fair interpretation of the Treasury Secretary's remark. But after the election, let's just play out two scenarios. Assuming President Trump is reelected, might further expected changes in personnel at the US Treasury Department and the Office of the US Trade Rep make current leaders in those posts reluctant to bind their successors. I'll just point out that it's not usual that cabinet secretaries carry over the second term of the same administration. It's not impossible. It's not, the law doesn't require they switch, but in fact, as a practice, that happens quite a bit. If former Vice President Biden wins the presidential election, it would be months before replacement personnel are in place to resume the negotiation. So there's a potential for the pause to last into early 2021 for a combination of those types of reasons. Now let's ask ourselves, how much technical work can get done during the pause? To some degree, this has been played a little bit by Pascal and the OECD as, don't worry, we're going to continue the work, and that's true. Pascal explained recently at a Bloomberg event that the pause can be used to move forward on technical work so that the inclusive framework will be, quote, near the solution and, quote, near agreement that might be expressed in a report, which I assume he may be referring to something we could potentially give to the G20 in advance of that October meeting. But let me make a few observations about that. Pascal has observed that the Secretariat members, I should say that the staff, the Secretariat is the kind of civil service at the OECD, and there's a lot of great people there, are deeply engaged in the ongoing and really complicated technical work that is needed to bring these proposals to the light of day. I would just add here that I have the greatest respect for the technical teams at the OECD and believe they are literally working around the clock to move things forward. I understand that they've produced hundreds of pages for the steering committee of the inclusive framework on a variety of work streams underpinning Pillar 1 and Pillar 2. But unfortunately, at the end of the day, technical work is not really divorced from political and policy. In my experience, when I was at Treasury with regulation writers at Treasury and IRS, and while representing the US at the OECD, the technical folks regularly need direction from the policy folks. And let me just offer a few examples. With respect to Amount A, the definition of a consumer-facing business might seem like a technical issue. But in the end, because it has different implications for different countries and industries, it becomes an issue in need of policy, political agreement, and consensus. Whether Amount B is done on a regional or industry basis may sound like a technical issue, but it cannot finally be decided at the technical level. Not to mention such core policy political issues such as, what is the agreed formula for Amount A? Is it going to be 10 over 10, 20 over 10, or something else? Will developing countries prevail in their desire to have a subject to tax rule take precedence in Pillar 2? So the real question is, how much will the policy players at the steering committee and inclusive framework be able to move the ball? I should have said, will the technical players at the steering committee be able to move the ball forward while their bosses are preoccupied by COVID? Not to put too fine a point on it, how much, while the Secretary of Treasury is preoccupied with COVID, can my successor, Chip Harder, who has been doing an incredible job over there trying to represent US interests, how much leeway will he get to agree to some document that might come out of the OECD? And so while I agree that the technical work can continue, I think it can only move the discussion so far in the interim. I think it will continue and companies need to stay engaged, but I think it can only go so far. That raises the question of, will papers come out in the interim? Would the US agree to let discussion papers come out? Might there be further public consultations? Typically, public consultations occur when there's at least enough consensus at the OECD to show something to the public and say, well, directionally, this is where we're going. And in fact, if we haven't had those to date, it begs the question just of how much technical progress really has been made in the works to date, putting aside the safe harbor issue and putting aside the current pause. People are interested in whether Pillar 2 can proceed independent of Pillar 1. I honestly don't know. As Pascal has pointed out, some countries view Pillar 1 and 2 as a package and won't agree to let Pillar 2 move ahead on its own. And my inclination is that may be the view that holds out. Pascal said recently, the biggest enemy of Pillar 2 is Pillar 1. And we'll see, where this goes. But I will also point out that even with respect to Pillar 2, there are tough political and policy questions that different stakeholders have. And so it's not 100% clear to me that Pillar 2 is simply ready to move out for political agreement. But whether it gets held up because of the pause in Pillar 1 is something we're just going to have to see develop. My instincts are it may well be held up, past any political agreement in October. A few other observations. First, it's not at all clear to me, and I think I've been demonstrating this point. It's not at all clear to me that but for issues around the US safe harbor or the recent request for a pause, countries are, quote, close to a deal. I don't have time to go into the detail here, but there are myriad open issues, some of which I just referred to, ranging from the revenue threshold for inclusion amount A, to whether developing countries are ready to sign off on a dispute resolution provisions that bind them in some way. This project was extremely ambitious and very challenging from the start, even without the complications of safe harbor and a pause. Second, the Treasury Secretary's observation in his December 3rd letter referred to the broad support that an OECD agreement must have in the US stakeholder community in light of the fact that things agreed by US Treasury at the OECD require domestic legislation and or treaty modification in order to be brought into force. Unlike in a parliamentary system, US Treasury simply cannot bind the Congress, legally or practically. And this is also true when the same party controls the White House and both houses of Congress. This particular challenge will not go away whether President Trump is reelected or the Democrats take the White House in the fall. Now, there's a new element since COVID. COVID has impacted the global narrative insofar as non-US countries will argue, and Scott made a reference to this in his opening, that the reality of COVID should justify a renewed focus on tech companies. The finance letter that in response to the Mnuchin letter on June 17th makes this plain, and Scott referred to it. I just want to read the whole quote to give you a sense of the flavor that I think is perhaps going to take hold around a lot outside the United States. The current COVID-19 crisis has confirmed the need to deliver a fair and consistent allocation of profit made by multinationals operating without or with little physical taxable presence. The pandemic has accelerated a fundamental transformation in consumption habits and increased the use of digital services, consequently reinforcing digital business models' dominant position and increasing their revenue at the expense of more traditional businesses. Digital giants, no matter where they're headquartered, will emerge from the current crisis more powerful and more profitable. These companies benefit from the free access to the European market. It is fair and legitimate to expect that they pay their fair share of tax within countries where they create value and profit. So the real question is going to be, will those sentiments take hold? And in that letter, they use those sentiments to suggest, as Daniel mentioned, that, well, maybe we should just do the digital now because this is such a pressing issue and these COVID realities are changing the reality. And then will similar sentiments fuel an acceleration of the pace of DSTs down the road when countries seek to recover from DSTs? Conscious of time, let me just close by observing that, as sometimes happens in life, in some ways we're back to where we started when I was introduced to the BEPS project in 2013 as the Deputy Assistant Secretary for Treasury Policy. Secretary Mnuchin, in his June 12th letter in remarks, echoed by US Trade Representative Robert Lighthizer, explained, and again, I'm just going to quote the letter, the United States believes that any reform of the international tax standards that have served the global community must apply on a broad basis and must not place the financial burdens predominantly on the businesses and physical interests of a single industry or country. And he rejected the idea put forth by the finance ministers that we phase in Pillar 1 by focusing solely on the digital service companies. So we're back to this underlying tension. Will the rules just change for US companies and the US, or will they change more broadly? Now, everyone acknowledges that multilateral solutions are superior to unilateral measures, not least, as Daniel pointed out, because income tax solutions that avoid double tax are the economic gold standard for global growth. And so if we can return to those principles, we can make real progress. And we should all strive for that, as hard as it may be. And with that, I think we're going to go to Kathy on some more talk on the DSTs.
Unmuted. Okay. Thanks, Bob. I appreciate it. You know, the one thing that I think people have to think about when you start looking at DSTs, as Daniel pointed out, it's not just that they're discriminatory, and it's not just that countries are looking for ways to put pressure on the OECD. One of the things that the EU had said when they first put their DST on the table last year, or 2 years ago now, was that we need to pressure the OECD into reaching some sort of an agreement. And if we don't have any sort of pressure on these digital companies, then we don't have the same drive to move this project forward on a quicker basis. What's happening now, unfortunately, is that a lot of countries, because of COVID and because of economic problems, are looking not just to the OECD and potential problems at the OECD, but they're looking to the digital companies and saying, this is a great way to raise additional revenue from companies outside of our country to help fund our economic growth post-COVID. And so they're looking at it in a very similar way to the European countries, but it's happening on a global basis. I mean, Daniel showed really the picture of where the DSTs are moving in Europe, but they're happening around the world. And the number of countries that are now starting to add digital, to move to digital service taxes is growing. There was an ATAF policy paper that was put out a couple weeks ago explaining how the African countries can move to DSTs and sort of giving a blueprint and a primer for how they can do it. Other countries are moving very quickly. And what we're seeing is that they're not using the French model as the basis for the DSTs. They're expanding them, and they're adding more and more companies and more pieces of industry to the DSTs to show that they can raise even more money. So they're not just looking at the platforms, they're also looking at the facilitators. They're moving forward so that people who have not been caught by the DSTs in the past are now being captured. I think that both the India and Indonesia models are showing that they are moving forward in a broader basis. And I see that as the model that other countries are going to look at, because the more companies that they can capture, the more revenue they can raise. And that's a real problem with how these DSTs have been designed. The French, started in a lot of the European countries were looking at the French. But once the OECD started to work and started to broaden the definition on what fell into the tech companies, including cloud services, all of a sudden DSTs started to expand to include those additional services as well. So we are looking at a lot of pressure that first started to put pressure on the OECD to move forward, and that's no longer the case. Countries now need the money, and they're looking for any way to raise additional funds, and this seems like an easy way to do it. And because enough of the large European countries have done it without any response from the US to date, they look at it as not having a downside to moving forward with it. The USTR had done a 301 investigation on the France DST. They came out with a list of potential tariffs against the French. The US and the French reached a mutual decision to put a pause on the trade war between the US and France while the OECD negotiations move forward. Part of that negotiation was that the French would broaden their discussion to not just try to tax US tech companies as part of Pillar 1, as Bob and Daniel have explained. But the other part was that the US would not impose Section 301 tariffs against France if they can reach an agreement at the OECD, and France would put a pause on the collection of DSTs. They did not put a pause on the actual tax. Companies are still accruing the tax. They're still going to have to pay the tax at the end of the year. So France is still going to get their money. They're just not getting it in the same time frame that they were going to otherwise. And not only are they getting their money, they also have no 301 tariffs that have been placed against them. So France has sort of gotten a sort of win-win out of this situation. They've had a pause in the 301, they still get to collect the DST, even though the OECD hasn't reached agreement yet. So it hasn't really worked to the US advantage on that front. The US has initiated 301 investigations recently against 10 other countries. Austria, India, Indonesia, Italy, Turkey, the UK, Brazil, the EU, the Czech Republic, and Spain. Some of these countries already have DSTs in place. Some of them have them proposed and are moving forward with them. Some of them have just started to have the discussions about them. But the US looks at this as potentially discriminatory tax treatment, and that the US has an opportunity to once again figure out a way to move forward on tariffs. There is a hearing, there are comments on the 301 USTR investigation that is due to the USTR by July 15th, and we will see sort of what happens after that, but I don't see that they're going to go in a very different way than what they did against the French. The question then becomes, what can companies do, and what are the alternatives, and what are the options really available to companies as they move forward and look at these expanding DSTs around the globe? I mean, right now, the US and France, when you start to look at our relationship, the way the French DST is designed, it's outside the scope of the US-France bilateral tax treaty. Possibly. I mean, there are some there is an Article 2 non-discrimination clause included in the French treaty that companies could challenge under the French treaty, even though the rest of the bilateral does not touch on the DSTs. This non-discrimination clause could potentially be a way for companies to look forward with that, because it has to do with national discrimination. And because of the way the French global numbers are for which companies are hit by the DST, not just the amounts that they have in France, but also on a global basis, they could use that as a potential way to challenge the French under the bilateral tax treaty. Our bilateral tax treaty provides for a map process so that they can actually challenge that under that. And we also have, under the French treaty, a mandatory binding arbitration provision. So if there is no agreement between the competent authorities under that process as they move forward to try to look at if there's a potential for using the French non-discrimination provision, that if they can't reach agreement could end up in binding arbitration, which means that a third-party panel would determine what the tax implications were. So that's one possibility. I think it's a little far-fetched, but I think it's not off the table. It's something that companies can look at. The other thing I think that the U.S. could do, besides the 301, is challenge the DSTs under the GATS provision, General Agreement on Trade and Services, under the WTO. Most of the countries that have designed and proposed DSTs are part of the WTO. And under the General Agreement on Trade and Services, you have a national treatment provision and a most favored nation provision that countries have to abide by, which means that you can have certain things that you can have as discriminatory treatment, but across the board, you have agreed that you are going to be revenue neutral and tax neutral across countries as part of this discussion. And as both Bob and Daniel pointed out, there is a very clear distinction between taxes and tariffs. And the way the DSTs have been designed and the way the letter has been drafted from the finance ministers, it's pretty clear that the DSTs could be considered tariffs. And so under the most favored nation provisions and under the GATS, that could easily be discriminatory. The problem is to go to the WTO, which this administration is not very strongly supportive, you would have to have the U.S. bring a case before the WTO. And unfortunately, that can take many, many, many years. I mean, for those of us who have worked in the tax field for a long time and remember the FISC-ETI fights at the WTO, we know that this is not something that's easily remedied, nor is it something that can be dealt with in a hurry. So, these are other options that we have to try to tackle the DSTs. This administration has agreed, has decided that the Section 301 tariffs is the way to go. What they have to do is they will do the comments, they will hold a hearing, they will have to write up a report on each of these various 10 new tariff possibilities that they have out there. And then the US will have to determine how they're going to react. For the business community, the Section 301 can be really problematic because it is difficult to say exactly how this is going to help US companies. There are some countries with DSTs who have already said they don't really care about the US 301 investigation. The Czech Republic has said, if the US does a 301, we will raise more money from our DSTs than the tariffs will hurt us with the US consumer market. Tariff increases really increase taxes and increase the cost to US consumers. These are not taxes on other countries. These are taxes on US consumers buying the goods that are coming from other countries. And for the EU, they have said that if the US puts tariffs on, that the EU as a whole will retaliate. Whether or not they can do that and get the unanimity to do that as the EU, but EU countries will retaliate, and they will not necessarily retaliate against the tech type companies. They will go after a broad base of US companies, and they will go after those who will hurt some of our companies in particular jurisdictions for political purposes, to make sure that the companies that could be retaliated against in return could have nothing to do with the DST fight as it is. So there's a great deal of concern within the US business community. We look at the DST as a discriminatory tax, and we would really like the US to be able to step up and do something about it. We strongly support the OECD process, but again, we do not support that the OECD process should just focus on digital. We agree that that is discriminatory tax treatment, and it also doesn't really help move the ball forward as far as fixing problems with the international tax system that will last. This is just the current situation, and as has been said multiple times, you cannot ring fence the digital economy. Everything's becoming digitized, and where do you draw the line on who's in digital and who is not in digital? Pascal Saint-Amand has been saying that since the COVID crisis and that everyone is relying on digital companies, as we are right now with this Zoom meeting, that the digital companies have ring-fenced themselves. I think that's a trite statement, and I think that it is really not a fair statement as well. If we're going to fix the international tax system, we should fix it for everybody and not go industry by industry. I do think that the DSTs are going to proliferate. I am concerned about a trade war. I am concerned about how this will move forward. I would like, sort of everyone to take a pause. I mean, we do have an election coming up. If the 301s have not been put forward by the end of this term, or whoever is in the White House in 2021, I do think that we need to take a look and try to find a way forward in the multilateral process to try to stop the proliferation of DSTs. But I do fear that with the COVID economic problems, that more countries will feel that they don't have too much at stake from the US on a retaliatory measure, and they will continue to proliferate. So with that, I'll send it back to Scott for whatever questions that you have out there.
Well, thank you. Thank you all, the panelists. Those are brilliant comments and very, very, very informative. Well, Kathy, let me start with you, and then there are a ton of questions that are coming in, and I want to get to as many as possible. But let me start with you, Kathy, since you've raised such interesting issues. I am old enough to remember and have lived through the Cold War, admittedly as a kid, but I remember the concerns over arms control, proliferation of weapons. There was a whole theory of, the MAD theory of, mutually assured destruction. The question is, and we tend to use a lot of warlike terms in this debate, trade war, tax war, et cetera. How do we de-escalate this? What is it going to take to sort of calm this and ratchet down the policies and the rhetoric?
Well, I think, Scott, one of the things that we have to remember is when we started this discussion on Pillar 1, it wasn't just focused on digital, nor was it focused on phasing in. It was a discussion of where are, where is value created and where are the markets. And, we started with this, with marketing intangibles, we moved to this whole pillar one, reallocation of profits. And I think that one of the things that we have to start to look at is that if you're looking at pillar one, what is the goal there? Is the goal just to raise money? Is the goal just to go after the tech companies? Or is the goal to really find a way to stabilize the international tax system under the new 21st century, way of doing business? And if we look at that and we have people take a step back, there's a chance that we have an opportunity to have a broader discussion and maybe change the discussion a little bit. I do think that if you're starting to look at a way forward, having other countries have some skin in the game and having other countries say, okay, let's look at how we really ought to design a new tax system as we move forward. And I think that could, have more buy-in from the US, which would make it a little bit easier to de-escalate some of our trade concerns with the DSTs. But I think all countries have to have something at stake. And by turning it on to just digital as part of pillar one, they've changed the focus of the discussion. And by changing that focus, I think that has pushed the problems that we're facing today. I think stepping back and broadening the discussion again would possibly help calm things down.
Well, thank you. I got a question for Bob and Daniel from our friend Georgia Maffini. How do you see pillar two working with guilty and beat? Kind of an interesting technical question, Bob.
Yeah, so look, there's no doubt that if you're at the US Treasury and you're going over to the OECD to negotiate pillar two, so pillar two has two pieces, right? There's an income inclusion rule like the guilty, but then if a country doesn't have a good income inclusion rule, other countries can deny deductions on payments throughout the chain of companies below the parent. Well, it's very difficult for the US Treasury to go over and argue anything other than our guilty is a good minimum tax, should be grandfathered, but at the same time, and therefore we should never be subject to these under tax payment rules. Now, George's question mentions the beat, because the rest of the world is going to say, well, that puts us in an awkward position because we will turn off the under tax payment rule because you have guilty, but you're not turning off your under tax payment rule in the beat because you would need Congress to do that. And I take the point that that is one of the, I think, sticking points, although I think the US has felt pretty confident that it's going to be able to get guilty grandfathered. And I don't think the US can go abroad and commit, for example, to repealing BEAT for the reasons I alluded to earlier, that Treasury doesn't bind the Congress. So, but then now the question is, can you get the consensus around Pillar 2 on that very important point that Georgia raises?
I think in addition to that is that if you start grandfathering guilty, you may have other countries that say that their CFC rules that have some sort of minimum tax or formulary kind of minimum approach would also be grandfathered, and the under tax payment rule should be turned off for them. So it's a question of like how far this grandfathering is going to go, whether it's going to be a permanent grandfather for any changes to guilty. There's a lot of interest in the U.S. for some changes to guilty. How would that impact whether it's a grandfathered policy or not? I think there's a lot of questions there, even beyond what Bob was talking about. So it's really just unclear. And I think back to Bob's earlier points that you can't really resolve these things without getting back to the table and working through the political issues. So sure, technical work can move forward on some measures, but without full engagement from all parties, then you're not going to be really able to resolve these.
Well, Kathy, let me throw you a curveball here, and this is a fair question coming from another friend of ours. Why doesn't the U.S. lead in this debate? We're doing a lot of complaining about unfair treatment, et cetera. And the question is, I guess maybe aside even from the safe harbor, is there a U.S. proposal that would solve these differences? Any thoughts about that?
I think that the U.S. could have taken a better lead and could have done a little bit better job in explaining the problem that they're currently facing. When the rest of the EU particularly decided that they wanted to take the consumer product companies off the table, they basically were saying, we want to protect our national champions, but we don't necessarily want the U.S. to protect their national champions. I think what the U.S. had to do up front is say, we don't separate them, we don't do this in phases. We really need to have a policy that looks at the broad tax picture and look at it from a perspective. I do also think that the safe harbor proposal that was put out last year was a little bit difficult for people to understand. The U.S. has a lot of safe harbors within our tax system, and we work at them differently than other countries do. And trying to explain what a U.S. safe harbor is to another country, I think just makes it more complicated. I do think that as they're working through both the issues and the technical stuff, there's going to be a lot of problems, because this was supposed to be a system that the inclusive framework countries would be able to manage. And to simplify this system, I think you're going to have to sort of step back a little bit and try to come up with a more simplified approach. I think the approach that they're looking at right now, even if it was with digital, is incredibly complex. And I think for a lot of countries, they're going to have difficulty administering this. I think if the U.S. can move forward and say, we need to look at a better way to resolve all these international problems, I think that, we will be able to find a way forward. But sometimes I think we need to take a step back and look at why we started this process to begin with and what the overall goals were.
Let me follow up with that and maybe start with Daniel. There are a number of questions are very similar, and let me see if I can bring some of them together. Essentially, are there alternatives for the unilateral DST propositions? What's wrong with just moving to sales tax system or VAT type systems that operate in Europe or expanding VAT as a solution to just a specific tax on a specific industry?
So that's a great question. So I'm going to go back to the OECD's Action 1 report back in 2015, where they made pretty clear recommendations on a digital approach to modernizing VAT systems and catching different digital services that are provided to customers in various countries, and outlining ways to expand VAT bases to make sure that final consumption, including final consumption of digital goods, are captured. And a lot of countries have made a lot of progress on changing their VAT rules to capture digital services. And that's a good thing. Digital services that are competing with domestic physical services for final consumption should be treated similarly under a VAT. However, there's a distinction between what countries think of as these indirect taxes, like the VAT, versus direct taxes. And income taxes. And on the income tax side, that Action 1 report basically said there are ways that we've thought about changing things and hinted at things that have now become digital services taxes and virtual permanent entity, physical permanent establishment rules. But there wasn't agreement. And that's where things have progressed from there. A lot of countries have looked at these virtual PEs saying, hey, if you are reaching into our country with contracts, with sales, and you meet a certain threshold, then we're going to tax you under our income tax system. That seemed to be a way that Pillar 1 might have developed to set up a new global standard for this virtual permanent establishment rather than all these unilateral measures or this narrow approach. But that seemed like what it was going to look like last summer. And then they decided to narrow it down just to certain businesses or just certain types of, these residual profits. So I think that's one of the things, like Kathy is saying, to take a step back and think about what principle is at work here with direct tax and how can you change that for the modernizing economy, the digitalizing economy.
If I could just add 2 quick points. Number one, it was my perception when I was in government, countries didn't like the VAT solution as a substitute for the income tax solution because politically their consumers feel like they bear the VAT because it shows up on their purchase. And what the political people outside the US needed was a solution that looked like it was going to hit the companies. and not the consumers, regardless of the real incidence of taxation. Number two, Daniel's last point of might we have just looked at let's say a virtual PE, let's keep an eye on what the EU does, because they're kind of waiting in the wings to see if the OECD doesn't make progress. Might they come back with both their own European DST and a European virtual permanent establishment approach? So there's always more players than just the OECD that are in the arena.
Bob, let me follow up with something, an interesting question here. We have really, I think, probably the smartest viewers out there. Rather than ring fence digital or tech companies, should there just be ring fencing of all high margin, high profit companies? And doesn't Pillar 2 partly achieve this? Kind of an interesting angle on that.
Yes, I mean, you can certainly, it's a great question because the world is struggling with what is consumer facing mean. And as Kathy's pointed out, we're also struggling with the principle. Because the minute you threw the cloud into automated digital services, which are typically B2B, you've really made everybody scratch their head about, well, what does the marketing intangible angle have to do with a B2B, cloud business? And so that leads you intellectually to say, well, maybe these artificial distinctions of digital and consumer facing could be broadened out to kind of high margin companies. And then is that what we are achieving through Pillar 2 with the min tax? So they're not exactly the same, but again, if you're just ensuring companies pay enough tax, that's kind of what Pillar 2 is doing, although it's not shifting the locus of the tax, which is part of the purpose of Pillar 1. So it's tricky, but I think the questioner is pointing out that we've kind of boxed ourselves in with these very tough definitions, particularly, I think, in the consumer facing, which is something they're struggling.
Well, we only have a few minutes left, so this is going to be kind of a lightning round, a couple questions here quickly. And I think this one is kind of interesting and perhaps that gets to the crux of it. And maybe this is a question a lot of companies are asking as they debate this. Which of the outcomes are more likely and which is preferred? 1, OECD Pillar 1 agreement. 2, unilateral DSTs and a trade war. Oh boy, what a loaded one. Kathy, we'll start with you just to put you on the hot seat.
I think number 2 is the worst idea. I think unilateral measures in a trade war is the worst case scenario. And obviously, we would like to have this be a multilateral agreement. Where and how we can take a step back to reach that agreement is obviously very unclear from our discussions. But I do think that more unilateral measures don't help. I mean, obviously, countries are sovereign; they can do what they want, but doing so in a discriminatory fashion against one country's companies is not a good solution in a multilateral tax world that we're living in right now.
But you've probably heard for companies like we have that some say, hey, we under Pillar, we wouldn't even be impacted by Pillar 1. We'd much more deal with the DSTs. What do you say to those folks?
I think that for a lot of companies, as we've said, DSTs are expanding. What started out as a small DST that companies didn't figure that they were going to be included in, all of a sudden is expanding, and that's just going to keep growing. And if the multilateral process slows down or we have some real problems with it, even more than we do so now, more companies are going to be swept into these DSTs. And I think that's going to create even more problems for companies. I know right now there are companies that say, I'll never be caught in a DST. I could be caught in Pillar 1. This is a way forward. But I do think that finding a multilateral approach that doesn't necessarily focus strictly on a particular group of companies is the way to go. You may not be in this today, but that doesn't mean you're going to be out of it tomorrow.
Daniel, any thoughts on that one?
Yeah, I'd agree with Kathy. The way that these things are changing, the way that it's just difficult to pin down what these DSTs are targeting in some circumstances, especially with policies like we've seen out of India. It's going to be a broader issue, and you're really going to need multilateralism to avoid some sort of really spinning out of control tax and trade war. It's going to rely on both the U.S. Not overreacting, and for the countries that are putting these unilateral measures forward to be able to step back as well. It's going to be both sides of the field there.
How many thoughts on that?
Yeah, just let me make it. I think we could have both, because the time it's going to take for the OECD negotiation and implementation through statutes and treaties, in my own estimate, means we don't really get an in-place solution until maybe 2024. In the meantime, we're seeing the DSTs creep up. And so you need to get countries to commit to walk back from DSTs once a new approach is in place. You don't have to have that negotiation. You could say you should walk back now while we're negotiating. But I've heard countries say, we're going to pull back our DSTs when Congress enacts whatever we agree at the OECD, what the parliaments put in. And so we're going to look at a few years here without, if nothing else intervenes, of these DSTs proliferating while we're waiting to enact whatever we get to agree at the OECD. So we all just have to appreciate that.
We are running up against the end of our time, but I did want to ask a domestic question, which we've gotten quite a few that are sort of intertwined here. One asked, do you think the Wayfair decision will have an impact on digital taxation proposals at the OECD? We can ask in reverse. Are the state level DSTs that are being proposed complicating this issue from the US perspective? The one most recently in Maryland, and others are being considered elsewhere, even in one was proposed in New York. Does that now change the way that the US looks at this? Kathy, I don't know if you've...
I've been paying very close attention to all of these, Scott. I mean, first on Wayfair. Wayfair is a consumption tax. Our Wayfair is much more like the VAT than it is anything on the income tax. It is just the US is now doing the same thing on digital services and goods, that particularly digital goods that other countries have already done under GST or VAT. So that part is not really part of the DST part. On what the other states are doing, we are hearing a great deal from other countries saying, why is the US opposing this while various states are already starting to take a look at this? It's pretty clear that there are some places within the US that think this is a good idea. Fortunately, they have not necessarily moved forward because we do have the Internet Tax Freedom Act, and some of those state proposals don't stay with the Internet Tax Freedom Act and they would fall. But I think just in general, it becomes a real problem for us in having discussions with other countries that the states have been becoming a lot more aggressive in this area.
One last question for Daniel, and then we'll have to close it out. I apologize for we just too much content and not enough time. Daniel, what do you think of the delay here will mean for the collection of data as we move forward? And would that, you mentioned that the data that was the OECD relied on when they did their estimates of Pillar 1 and Pillar 2 were old, 2016 and before. How might newer data change that calculus and our perceptions about the impact of both Pillar 1 and Pillar 2?
So I'll say two things. One, the delay could allow better data to be put into these models they're using to estimate the tax revenue from Pillar 1 and Pillar 2. Another piece of this is one of the BEPS action items was to monitor the impact of BEPS policies on actual profit shifting. And instead of actually doing a full review of the US policies and EU and other country policies that are meant to stop or address profit shifting, they've moved on to a new sort of proposal. So it's possible that there's time now for the OECD to say, hey, we need to evaluate where things stand relative to the baseline when these policies were put forward, to know how much profit shifting is left out there to tax. And as you mentioned, like the data that the OECD was looking at was from 2016. Every year, new data comes in and new implementation of measures to address profit shifting also comes online. So it's really an opportunity for more up-to-date, more recent evaluation of the policy measures and a better understanding of what Pillar 1 or Pillar 2 would do as far as revenue raisers.
Well, I want to thank all of you for your really informed and interesting and insightful comments. And I promise to, or hope to wrap this up before the church bells across the alley from my office started at noon, but I'm like Quasimodo in here as they start going. So we'll wrap this up. I appreciate all of your time for this. For those of you watching at home or in your offices here and abroad, please feel free to review the taped version of this later on or pass it along to your colleagues. We'll be having more of these events in the future on topical issues, both domestic and international. So I hope to see you again soon, and tune in to the Tax Foundation. And please refer to our website where we have a lot more information on this and other issues that I think are of interest for all of you in the tax community. Thank you again for tuning in. And